The August jobs report beat expectations, and we've got some historical analysis from you-know-who, Yahoo Finance's Jared Blikre, or Dr. J, joining us with the breakdown. Hey, Jared.
Thank you, Rochelle. Well, here's an interesting chart I dreamed up here. This looks at the SPY, and that's the S&P 500 ETF, cumulative net returns on employment situations days. So if you look at the close on the Thursday before and then the close on the Friday, and you add all those and subtract if there's any losses over time, this is what you get, this blue line. Now, in gray in the background is the actual performance of SPY, or the S&P 500. What we can see here is they largely track each other. Sometimes the employment situation report has been a little early and maybe predicted a downturn, you might say, but it's also been late. So kind of a mixed bag like there. I'd say on this upswing here, the indicator was a little bit late. But what I'm interested in is what's going on at the right-hand edge of the chart here. And we can see, despite the market has largely been going up here, we do see this downtrend in the indicator. That's actually going to tick up a little bit today. But for the most part, I think we would want to see these two in unison. What I'm really interested in is seeing how SPY reacts also to the CPI reports. That's actually an even tighter correlation. And so my thinking is when I see a couple of big down moves on one of these two reports, or both of them, the NFP and CPI, that's probably it. That's probably it for the rally for a while. I don't think we're there yet. So just something to think of for the coming weeks and months, guys.
All right. Yahoo Finance's own Jared Blikre there. Wait, while we have you, Jared, as we took off the first trading day of September, is it time to rethink your portfolio?
Let's take a look at the VIX, because lots of different seasonality studies on September are showing that not only does the VIX tend to spike up, equities tend to sell off. But something interesting is happening this year, and in particular with the VIX over the last 6 days. We've seen this really big downswing in VIX. That is a risk-on signal. It means that there's less volatility, less expectations of volatility in the market. And we've come all the way down to the lows of the year there. That's only a 3-month chart, but that is the lows of the year. So what happens in September and October? That's back to school. That is prime time crash season, because a lot of big institutional players do not like to establish new positions or rollover positions in the summer. So it's just kind of understood that in September, you get a new narrative, you have a massive repricing a lot of times. Sometimes that spells trouble for the markets. And I've cooked up some of these statistics here to show what happens on an historical basis. There's our chart from before. Here's VIX and what happens to VIX. Usually the seasonality is, here we are just coming out of August. You can see September a little bit higher, October a little bit higher. Then we get some relief in November, and then Santa Claus rally in December. But we have to get through these 2 months first. So I said the year is a little bit different this year. Here is showing S&P performance by month. The purple line is September. You can see going back to 1960, if you invested $1,000, it would only be worth about $600 now. So September, not usually good. But this year, we had something interesting happen. We had a huge rally into the end of July, and then we had a drop off in August. When I take a look at these years, we have overwhelmingly bullish results for the end of the year. September, October green, November, December, all of those green, with the also pretty high percentage hit rates, except for October, which is only about 64%. That's 7 out of 11. So what should we expect for September? Well, it's usually a bad month for equities, but because of the huge performance that we had earlier in this year, it might not be that bad. Hopefully we'd be able to skate by with a few hiccups into year end. We know there's going to be a lot of focus on the Fed and all these reports. So I think the one thing that could interrupt all of this goes back to my original chart here. I'm going to be looking at the market reaction like this. On days like this, and also on the CPI days, for those big downswings. And hey, we're not there yet, so that's cause for optimism.
All right. Thanks so much, Jared. We'll be keeping a close eye on that, as we know you will as well.